Hey everybody, quick follow-up to our class on Wednesday when we looked at the start of Chapter 9, which is foreign exchange rates. The first thing to note is that you're coming into this topic knowing a few tools, and we're going to use those tools in Chapter 9 and throughout the rest of the course. Number one, you know journal entries. We're going to see journal entries in this course are going to be a tool. So in earlier accounting courses, you might have, you were learning kind of how to make a journal entry, debits and credits, and those rules and that kind of logic. We're going to kind of use those as a tool to understand the nature of what's happening, the flow of money, and kind of some more complex transactions that we want to understand when we look at more complex business in a global footprint. We're going to look at a transaction that occurs on account, so a sale made on account. You know this. You understand from Principles 1 that when you sell an account, you have a sale, and you credit the sale, credit revenues or sales revenue, and then you debit account receivable. And then you also know that in 30 days or whatever the time period is that has to be paid off, you're going to have the payment, which is going to involve cash, and then the account receivable coming down. Finally, we're going to be doing some math. Okay, we're going to learn some new terminology. Again, accounting is a language of business, and you're continuing to learn new terminology and new ways of applying some of the logic and newer and more advanced accounting topics. Okay, and exchange rates is one of those. So let's look at the transaction that we're being asked to analyze. It is a U.S. company called Mattel, a toy manufacturer, selling £1 million British worth of toys to Hamleys. Now, British pounds, Great British Pound, that's the currency used in the UK, okay? They use British pounds. Versus in the US, we use US dollars, okay? So when I say pounds, I don't mean the weight of something. That's just a quick kind of upfront point so that we're not confusing terminology here. So they sell the toys on January 1st on account, okay? 30 days later, on January 30th, the account is paid off. So this is the kind of familiar piece of the transaction, the idea that you can have a sale and then payment comes later. What we want to look at here and what's key to understand in this transaction as a starting point with Chapter 9 is that Mattel is a U.S. company selling £1 million British pounds worth of goods. So the sale itself is denominated, what we would call denominated in British pounds. So when we set up the sale on January 1, when we book sort of the credit to sales and a debit to account receivable, we want to show that £1 million Great British pounds worth of toys has been sold. But we need that to be shown in US dollars for purposes of Mattel's books. And that's where the exchange rate comes in. I'm going to tell you right now that we're going to take the exchange rate here in this example is 1.3. That's 1.3 US dollars to 1 British pound, okay? So $1.30 will buy you 1 British pound on January 1st, okay? We're going to practice this, okay, this idea and kind of the terminology and how we apply it. For now, just know that if we have £1 million worth of toys that are purchased, then the sale in US dollars will be 1.3 million US dollars. And what we're doing there is we're taking the million British pounds, multiplying it times the exchange rate to get to $1.3 million. So what we're going to do is we're going to show that a $1,300,000 sale has been set up, and a receivable has also been set up for $1.3 million. Again, I'm going to put in here just that this is dollars, but just know that by virtue of this being Mattel's books, it's in dollars because Mattel is a U.S. company, okay? All right, 30 days then passes. Exchange rates, as we're going to learn more in this chapter, they fluctuate over time, okay? Exchange rates are constantly changing. Each day has a new spot rate, meaning what's the rate on that day? The spot date is like if you're looking at a single spot in time, what's the exchange rate? So the spot rate changes from 1.3 to 1.285 on the 30th. We need to take the £1 million British pounds and convert it now at that rate. Okay, so we're going to take 1 million Great Britain pounds, and we're going to multiply it now times 1.285. So now we're going to, and here's the business sort of operational perspective on this. Hamleys is going to send a cash payment for $1,285,000 in cash, because this is the Great British Pound equivalent of £1 million, which was the initial receivable that was set up. But the U.S. equivalent of that receivable on the 30th is now worth only $1.285 million. So on the first it was worth $1.3 million, now it's worth only $1.285 million. Now, we know from our journal entries that when we settle an account receivable, we're going to have this kind of, balancing effect. But we can see we don't balance, right? We've got 1.285 million of a credit to the receivable here. We have the initial debit was 1.3 million, so we have what's called a $15,000 foreign exchange loss in this case. Okay, the loss. And here's kind of, I'm going to fill out the journal entry and then we'll talk about it. We're going to put the $15,000 over here, and what I want you to note is that this is going to help us balance. Okay, so if you were to add up account receivable credits, account receivable debits, you'll see that we'll see that we balance. Now this is part and parcel with working on account with businesses in other countries. This is a part of global business. Exchange rates fluctuate. The important thing here, and we're going to see this in the chapter, is that the change in exchange rate doesn't mean that the actual sale is worth any less. The sale is worth £1 million British pounds, but it does mean that there is a U.S. financial statement impact. And what we want to do is we want to separately state that impact in this account called foreign exchange gain or loss. Okay? Now, in this instance, it's a loss. In other instances, it might be a gain. It depends on the fluctuation of the rates and how they changed over time. There's risk here, right? There's risk that you're going to incur a loss inherent to the fact that you are selling something and then getting payment later. Companies can mitigate their risk using financial instruments called derivatives. We'll get more into this material as we dive deeper. We're going to look specifically at this math here. I'm going to get you guys doing some exercises that give you some practice doing the exchange rates and computing them. And we're also going to look a little bit more at the journal entries and get some practice there as well. More to come. Thanks a lot.